Welcome, everybody. This is Buck Joffrey with the Consensus Network. Today, as I'm recording this, it's November 19th, 2018, and we are in the middle of a bloodbath. I don't know what it's going to be like before it ends, but as of today, Bitcoin had traded all the way down to 48-something, and it was ugly. But I should point out, one of the few podcasts here who's keeping them honest. In other words, I'm not having only people who are bullish, but also people who predicted this fall, namely Tyler Jenks of Lucid Investments, who was on a few weeks ago, who's been signaling. I've been following him on Twitter, and he literally called it. It was like a Babe Ruth call. It was pretty amazing. And even when he called it, I have to admit, I thought, no, he couldn't possibly be right when there's a Bitcoin Cash fork and you get Bitcoin ABC and Satoshi's vision. How does it have anything to do with Bitcoin? A, and B, people are going to flee this thing and they're going to end up with more money in Bitcoin. Well, I'm not a trader, so I got it wrong. Tyler is a trader, and man, did he get it right. And he's gotten it right. Now, to the extent that he gets it right, he has predicted this thing to go all the way down to 1,000 or somewhere around there, and then rebound over time all the way to 500,000. I mean, that's basically what him and actually a number of other technical traders believe. The issue is, what should you do? And right now, I'm listening to podcasts. I would listen to people in this space, and everybody's kind of quiet about it, right? All of a sudden, the podcasters are talking about things other than this and that kind of thing. But the reality is, I think you have to look at what's going on. Again, understand that this is a new market. It's highly volatile. We've seen this happen several times over the last several years. It's nothing new. People have declared Bitcoin to be dead on multiple occasions. They probably will do it again. I think the big difference in my mind, though, is that now we were sort of on the cusp of institutional money making its way into the space, and then on top of that, we had this ETF pending with the SEC. Personally, I think a lot of those things are going to get delayed now, because I think when you show this kind of crazy volatility, it suggests that the markets can still be manipulated. In this case, a lot of this was started by Craig Wright, frankly, with threats of dumping 1 million Bitcoin, etc. And then I think we hit some technical things. See, what happens with a lot of these technical trading issues, and I'm not a trader, but I have this sort of general knowledge, is that people put in what are called stop losses typically, and so they might have money sitting on a trading platform. If it were to drop by 10%, they want to capture some of their gains, or they don't want to lose any more, there's an automatic sell. And so I think you're running into a lot of that. I think you ran into it once that $5,900 area was crossed. I'm sure again when 55, and frankly, I mean, I think we broke into high 4,000s today. I wouldn't be surprised if we were down and it broke 4,000 and down into the 3,000s by the time this particular episode airs. So I think the moral of the story, though, is that, first of all, when you're in this space, and I've said it before, I've said it to my own listeners on this podcast, I've said it to people on other podcasts, is that we're looking at a very new asset class, a new technology. Inherently, it's speculative. And so one of the things you have to do is first make sure that you don't have 50% of your net worth sitting in this stuff, right? We're trying to capture the alpha here. We're trying to capture the upside, but if we do lose money, we don't want it to be money that we need in the next 12, 24 months, or even 5 years for that matter. We're looking at this as a long-term play. And in that regard, my thesis has not changed. I mean, I really do think that Bitcoin in particular will be, a six-figure asset within a few years. It may not be next year. It may not be the year after. But, I mean, look at Tim Draper says over and over. Tim Draper, who's he's got a big fund, big name in investor in crypto. He's got a hedge fund, and he says $250,000 in 5 years. And he says, what do you think of the current drop? And he says, I don't think anything. $250,000 in 5 years is what I think. So you could take that approach, and it's probably a healthy approach overall. I don't think anybody should be buying this stuff with money that they are afraid to lose. I've said it before. I'll say it again. This is money that should be your play money, instead of buying a car. On my other podcast, we describe it as, BMW money or whatever, things that you were going to buy, you didn't buy this year because you wanted to take a chance, and that's what you did. Just because these markets are crashing now doesn't mean it's the end of Bitcoin. Bitcoin's been pronounced dead so many times. It's like a cat, 9 lives. It's not dead. It's not going to zero. At some point, it'll find its support and it'll be back up. But in the meantime, it is scary times. I will give you that. No one likes to lose money, even if it's on paper. But also, it is something that I still believe in. So if you still believe in it and you're seeing the markets crash, you might be wondering, well, what kind of strategy might make sense? Well, if you're in this space and you want to just kind of get broad exposure and you're like, you know what, I don't know if Bitcoin's going to do it. I don't know if XRP, I don't know about all these new things that are happening, but I do think that there's something to this whole blockchain thing. I do think that there is something to this whole distributed ledger technology thing. And I want exposure to that for the long run. And I don't know if Bitcoin's going to win. I don't know if some other coin's going to win or whatever, but somebody is going to have a product or an asset that's worth a lot. That's a very reasonable approach. And so in the next few weeks, as you see these markets, fluctuate madly and, the market cap being as low as it is, it may make sense to potentially start thinking about layering in some long-term investments. Now, if you are an accredited investor, you are an advantage because you can do this without actually having to do self-custodianship. In other words, instead of holding it all yourself, getting a ledger and all that, you can invest in hedge funds, etc. One of the funds that I think is pretty accessible to most people who are accredited but maybe not ultra wealthy. So in other words, you make at least $200,000 a year and you want to put a few bucks into a broad portfolio of cryptocurrencies and set it and forget it. There is a fund that you can do that with, and you never have to touch a ledger. You never have to go to a cryptocurrency platform or have a wallet or anything. And it's called Bitwise, Bitwise Management. And this week's show is going to feature an interview I did with Hunter Horsley, the co-founders and the CEO of Bitwise, who will tell us exactly how that works. And as you can see, the market, we won't be talking about the market specifically as of right now because this was recorded a few weeks ago, but it'll give you some perspective and some ideas potentially on how to approach this market if you think it might be a good time to buy. So when we come back, Hunter Horsley. Now, there isn't much more exciting than cryptocurrency, but there are old-fashioned ways of creating wealth outside of Wall Street that have been used by the wealthiest families in the world for generations. And that's what my other podcast is all about. It's called Wealth Formula Podcast. Now, if you've made a lot of money in crypto and don't know what to do next, this show might actually answer a lot of those questions too. Again, it's Wealth Formula Podcast with me, Buck Joffrey. Welcome back to the show, everyone. Today, my guest is Hunter Horsley. Now, Hunter is the co-founder and CEO of Bitwise Asset Management. Bitwise was founded in 2017 and pioneered the first cryptocurrency index fund and has recently thrown its hat also into the ETF race, which we'll talk about a little bit, with the Securities and Exchange Commission. Hunter, thanks for joining us today.
Absolutely. Thank you so much for having me on the show.
So I wanted to start out a little bit just talking a little bit about you. You're a business school guy, so University of Pennsylvania. Well, at least you went to Wharton, so I'm imagining there's some business stuff there. What's your background in general? I mean, after you finished your economics degree at Wharton, how did you, find yourself weaving into the cryptocurrency space?
Thanks. Yeah, there were some steps in between. After school, I went to be a product manager at Facebook and Instagram. First joined Instagram and got to be part of the team that helped monetize Instagram, get it to over $1 billion in run rate. And my role there as a product manager was to work with teams of engineers, data scientists, researchers, policy people, partner managers, product marketing people, everything you can imagine to build new software products. In the case of my time at Instagram for our advertising clients. After that, I went over to the Facebook side, and there I did a number of things. One of them was while I was in charge of the branded content ecosystem, which is a multi-billion-dollar ecosystem on Facebook, an approach to monetizing digital media, and then got to help figure out how we would monetize videos, which ended up being putting commercials into videos. There again, as a product manager, I left to start Bitwise, and Bitwise is the firm that I'm now the CEO at. We do cryptocurrency index funds, as you know, and the transition. So the way I got from there to Bitwise was really organic. In 2017 in San Francisco, if you're software people, pretty quickly someone says, "Do you remember that cryptocurrency thing? Do you remember blockchains?" And I'm not an OG crypto person. I wasn't involved in 2009 or 2010. I had bought some Bitcoin back many years ago, but didn't really pay attention to it, didn't think much of it. And it wasn't until 2017 when it really became its own asset class that I started paying attention. And I should say my co-founder, who did software security in the military and had worked at Google, him and I both together sort of started taking a look at the space.
Interesting. So you hopefully you thought enough of your Bitcoin initially not to throw it out like several million.
I hung on to it.
Good. Yeah, there's a lot of computers sitting in, some dumpsters out there right now with millions of dollars of Bitcoin on them.
Yeah, I've heard those stories.
Being in the space for even a couple of years. I mean, it's like this space just travels at light year pace. I mean, it's unbelievable, right? And when you look at what happened in 2017 in particular, I mean, that's like crazy in and of itself. I mean,
yeah, absolutely.
And so obviously we've had a significant correction last year, which I'm curious kind of, when you guys entered and how that ended up playing out. Talk about that a little bit. How did that affect your fund and your outlook on cryptocurrencies in general?
Yeah. I wrote an article for CoinDesk, which is as you probably know, one of the most prominent trade publications, called 2017, the year crypto became a new asset class. And so I think the narrative that is common amongst our clients, and we talk a little about what we do, but we work with sophisticated investors, family offices, multifamily offices, wealthy individuals, and then institutional investors, so asset allocation committees and CIOs. I think the trend that we saw getting started in 2017 was, for most people, they hadn't heard of crypto before 2017. It was this tiny little asset class at $12 billion. It's barely an asset class, and that's what it was. Something near there at the beginning of January 2017. And then throughout 2017, it picked up steam, and we could talk about why that might be. But people started to notice, and that really came to a point around August, September, October, where everyone was hearing about it, be it in the news, some headline about a teenager becoming a millionaire, or a relative telling them about it, or a coworker telling them about it. And I think in that environment, what happened was a lot of the more nimble investors, so individuals, wealthy individuals who had the ability to take risk and to make decisions quickly, a lot of them decided to put some money into crypto at that moment. The professional investors, the institutional allocators, investment committees, advisors, at that point in time, they were asked to look at it because their clients were looking at it, or their board told them to look at it. And I think a lot of them were frustrated with it. Their first reaction to it was, "Oh my gosh, this looks like tulip mania, asset prices going like this, that's not something that should be happening. And we don't understand this thing. It's not backed by any physical asset, and it doesn't have cash flows." And so I think towards the end of 2017, what we had was a lot of individuals deciding to participate in the market, and a lot of the professional investors being frustrated. I think at some point Warren Buffett said something like Bitcoin is rat poison squared, and just having sort of a very negative knee-jerk reaction. Now that's sort of, in some ways, counterintuitively, that's changed in 2018. So in 2018, it's almost flipped. So the market peaked towards the end of 2017, December. And then in 2018, we've been in a bear market. The markets are down maybe 60% since the beginning of the year, at least our large cap index. So those are I think small cap and mid cap index is down a little bit more than that. And during that drawdown, I think the individual investors, some of those who had allocated in the fall of 2017, have become a little bit more hesitant, and in some cases, feel burned. And conversely, the professional investors and the institutional allocators have become way more interested, particularly over the last quarter. And I
Yeah.
think what happened there is, those individuals, as professionals, were forced to start paying attention in Q3, Q4 of 2017, but things are moving so quickly, they didn't have time to understand it. Prices were behaving in a way that prices generally shouldn't. And then in 2018, it turned a corner and started to drop down, and it didn't go to zero. And over the last 3 quarters, those professionals have had the opportunity to read about the space, research the space, meet with managers like us, have us in to speak to their asset allocation committees, develop their view on whether or not one day public blockchains and crypto assets will fit into their portfolios. And for many of them, the result of that view is that it would in some allocation size. And then if you look at the market in 2018, in Q3 2018, I think to many of them, it feels like a really attractive cost basis.
Right.
One CIO recently said to us, the most important thing for me to be doing in 2009 was just buying anything. And that remark was about the fact that in 2009, because we were going through the recession,
Yep.
asset prices were cheap, and it wasn't as important to call the bottom specifically as it was to be buying while things were cheap. And so I think that's the attitude that many of the institutional investors have had recently, is as they've been moving the market. We've seen Yale, Stanford, Harvard make announcements about allocating.
So let's talk a little bit about that, because I'm curious. I've been talking about this, on the Consensus Network weekly crypto news. I mean, in the last couple of weeks alone.
Yeah.
Listen, I think Bakkt now has an actual day, mid-December sometime, where they're releasing their first Bitcoin product, and Bakkt is owned by the same owners as the New York Stock Exchange, the Intercontinental Exchange. You have ErisX. ErisX, you had Fidelity announcements. As you mentioned, you had Yale's endowment now involved with cryptocurrency. So now what strikes me is interesting about this, and it sort of is curious, and I'm curious about your thoughts, is usually this kind of news, this is very bullish news, but
Yeah.
and you, to me at least, I would expect a bump, right? I mean, this is beyond rumors, although people usually buy the rumor, right? But this is reality, and to me, this is a signal of likely hundreds of billions of dollars emptying into the space. Why is the market as flat right now as it is? That's what I can't get my head around, and I'm curious if you have any thoughts on that.
Yeah. I think that there's 3 things that come to mind. The first is these endowments have made allocations. Other large families have made allocations, but it's still very small. This is the tip of the iceberg in terms of institutional money being managed coming into the space. So those flows themselves are not big enough to move the prices. And so I think the first thing I would say is to why we're not seeing a huge turn in the market is the flows coming from institutional allocators themselves can't cause the buying pressure to move asset prices. The second is what you might expect is the existing market participants, the managers of crypto funds, individual investors, to buy positions on the news upon hearing endorsement from some of the most well-respected endowment managers, that they would see the ratification of the space and buy that. But I think they're also I think many of the long-term participants in the market have sort of expected that would happen. They felt that it was inevitable. For many of them, they're fully allocated. And so I think for the existing market participants who recognize the significance of the news, it's not something that is really, I think, a huge surprise. I think the fact that it's happening now is a surprise, but I think that they always expected it would happen. And then again, I think they're allocated more or less. And so you would need, I think that the third thing on my mind is you would need significant new flows. And asset prices. If you think about real estate as a proxy, if you have this, roughly same set of supply of residential units, you need, a huge new set of buyers to come in to meaningfully change the trajectory of price movement. And so I think that can be institutional allocators, and we're just the beginning of that. I think the other is for the general investing public. And not just the existing market participants who interpreted this news, but people who are not yet in the market, who haven't heard of Backed, and who didn't read CoinDesk's article about Yale, right? And
Right.
I think for that audience, there are some pieces of infrastructure that need to be in place for them to consider allocations to crypto.
Is this
that aren't there today?
Do you think that, I mean, if I'm understanding you right, you've got participation and from family offices and maybe from smaller funds that are not required to necessarily have custodians. Is the custodianship potentially the big limiting factor? And obviously we've got, Backed and some of these others who are coming in that might be able to provide that. But do you think that's part of the limiting factor? Or?
I think it's part of it. I don't think it's the whole story. And I think sometimes for the sake of simplicity, it's many people in the space point to it as one of the big sort of binary factors. But so maybe I'll talk about custody for a second, and then I'll talk about what I think some of the other things are. The state of custody today, there are a number of custodians in the market, and it's rapidly getting better. So at the beginning of 2018, maybe there were 2 serious custodians. Now there's maybe 6. Not all of them are completely public. And then Fidelity just announced that at the beginning of 2019 they'll be offering custody. It's something they've been working on for a very long time, and there've been rumors that others like Goldman are working on solutions there. So I think that's going to rapidly get better. And the solutions that exist today are extremely robust. The firms are being run by very competent individuals. Some of them manage tens of billions of dollars, or very, very large sums. And while the regulatory status, the issue with being a qualified custodian, which is part of the Investment Advisors Act of 1940, you could argue that there is some additional clarity that's needed there. There's a strong dialogue with regulators happening between these players, and they're doing the set of things that need to be taking place to move into compliance. And there are already firms that have trust charters or broker-dealers, which is what it would take to be considered a qualified custodian, which is what people say the space needs. So I think that custody is in a good place and getting to a great place. I don't view the custody situation as there are no good custodians, there are no qualified custodians, and as soon as we have one, things will switch on. We do have qualified custodians today, at least in the way that that piece of regulation is written, and they're great service providers. They're getting better, more coming into the space. My perspective, the big sort of category that's holding back other investors is two things. One, education, getting up to speed on how to think about public blockchains and crypto assets, how to think about what they can do for a portfolio, which sleeve does it go in? Does it come out of their equities? Does it come out of their bonds? Does it come out of real estate? Does it come out of alternatives? And to build consensus internally. I think that's one piece. So we did a webinar with about 500 financial advisors. 80% said that clients had asked them about crypto, but one of the top barriers to investing was education. So I think that one element of what's needed for the mainstream of the professional investors and investing public to participate in crypto, one piece of what's needed is they need to understand what crypto is. In the same way that for most people, you're probably familiar with CRISPR, the genetic editing methodology or technology, right? So you could tell people CRISPR is this breakthrough technology. It's going to enable these improvements in how we do procedures. Here are some of the companies that are doing it. They understand that there's something important happening there, but they don't really understand how it's going to change their world. What it represents as an opportunity for them. And I think that's the relationship most people have with crypto now. So I think education, and then last thing I would say, and then I'll wrap up. But there's also workflow infrastructure. So our index fund is a private vehicle. It's available through Schwab, but most investors work with a platform like Schwab or Pershing or Fidelity or Merrill Lynch Edge, and they can't really access crypto through those platforms today. Many advisors want to work with a 40 Act fund. So that's an ETF or a mutual fund. They don't want to work with a private fund structure, or they don't want to buy assets directly. They need it to integrate into their reporting flows, the way that they pay taxes, the way that they manage portfolios. And I think a lot of that infrastructure and wiring that's behind the scenes is missing, and making the barrier to investing too high for the general mainstream. And it's also what creates the opportunity for people who are investing now, is that infrastructure is getting built, but isn't in place just yet for everyone to be able to participate.
Yeah, and it's interesting because I think a lot of those things that you talked about, I think 2019 is a big year for a lot of that infrastructure, a lot of those pipes to be laid. So,
it's happening now, and we actively spend a lot of time working on that as well.
So I assume then that your take, and I'm not obviously asking you to predict the future, but is that, this is going to be, as you've got, these more sophisticated institutional investors, sort of more of a, gradually, rising market instead of, going up to $25,000 in a matter of months this time around. Just sort of people dipping their foot in. Maybe they've got, 0.5% they allocate into this space, and they kind of just see how things are going. And there's also part of it is people not wanting to be the first one to do it, right? But then there's also a and again, I don't pretend to understand how these people think, but I would think that there's also this element that, all right, well, if Fidelity is involved, so if we lose money because we invested, through Fidelity, that's okay. But if I invested through somebody else and lost money, I'd probably lose my job, that kind of thing. So,
yeah. So I think some things to look for are, when access to crypto becomes available through the existing brokerages. So instead of having to download a new app that I haven't heard of and don't really feel comfortable with, if it becomes possible for people to easily access crypto through Charles Schwab, that'll be a big day. And that could happen through an ETF, could happen through a mutual fund, could happen through them offering direct purchasing, but that would be a meaningful moment for the space. I think another meaningful moment would be another bull run. Historically, Bitcoin's been around for almost 10 years, and historically it has moved in these big swings, followed by drawdowns, and then periods back up. And so that's the type of I think price movement that gets the public's attention. In the U.S., I think it's estimated that 8% of Americans own some crypto. So it's definitely not the case that most investors have participated yet. And so I think that's the second thing that would really impact people participating.
Yeah.
And then I think the third is seeing peers allocating to the space, and that's just happened now, and it has absolutely had an impact. The fact that CIOs we meet with see that Yale and David's firm are invested has changed the way they think about things. Now many of them have the thought process, which is, what does David see that I don't see? Or what do I know that David doesn't know that causes me to think that this doesn't make sense?
Yeah. And I think some people are, I'm guessing that some of these fund managers are looking at this saying, what's the cost if I don't invest in this and it takes off and I don't have, and I'm still at zero,
Yeah.
And if I can put in, if I can just, dip my foot into this, and if we have that same kind of growth, that could have real impact on the fund returns in general.
Absolutely. Yeah. We've done an analysis on, we do a custom analysis for firms, and we've looked at what is a 1, 5, 10% allocation to Bitcoin over the last 4 years. We looked at Bitcoin because it is a longer history, even though it's still a short history. But over the last 4 years, which includes starts with a drawdown, ends with a drawdown, in a 60-40 portfolio, so 60% equities, 40% bonds. If you rebalanced it, a 1% allocation added, I think, over 4 percentage points of return.
That's unbelievable, right?
A huge amount of return. Yeah. It decreased max drawdown, which is a risk metric. It improved the Sharpe ratio, which is a risk-adjusted return measure. And again, the worst case scenario, which many people don't think is very likely, but the worst case scenario that it went to zero, you only lost 1%.
Right.
And so there are different versions of that. You could do that with 25 basis points. You could
Yeah.
do that with 10 basis points. I think if for managers and individuals who resist the idea of owning any amount of crypto, you have to recognize that might be an emotional or philosophical or in some ways irrational view. Now, certainly if you develop a thesis about how things will play out, and in that thesis you conclude that it doesn't make sense as an investment, or your objectives for your portfolio don't include
Yeah.
something high risk, high reward like this, then it doesn't make sense to allocate. But if it's simply that you don't like the idea of investing in the category, um, you know, I don't know that is as common or popular of
Yeah.
an explanation as it was in 2017.
Or even like 3 months ago, right?
Yeah.
So let me ask you a question. But before we get into Bitwise more, I want to ask you a question, which is sort of I've been thinking about a little bit lately. Is that I remember hearing, and I've heard people say on many occasions that they considered, let's just talk about Bitcoin in particular, an uncorrelated asset. Okay, uncorrelated to other markets, but we did see I don't. To me, I'm looking at Bitcoin right now. I'm thinking that the majority of investors, and I'm not talking about those in Venezuela or other places where their fiat currency is not stable, but for most people, it's still kind of probably a speculative investment. So if it's a speculative investment, would it be uncorrelated? Or would it be correlated? Because I would think it'd be the first thing that you would sell off. And so at least until there's an established baseline, then maybe you can think about it as digital gold. But what's your take on that?
That is a great question. I think people are definitely of two minds. One mind is that it's a liquid risk-on asset, and so like a large cap internet stock exposure or a hedge fund exposure. It'll be the first thing to take off if you move into a recessionary environment, to move into more conservative investments. So that's one mindset, and I think that there's real merit to that. The other mindset, which you referenced, is that it's a hedge asset. Historically, it's had low correlations to equities, fixed income, gold, the U.S. dollar, the VIX. And that because it has different drivers of price instead of corporate earnings growth or interest rates, drivers are things like millennial wealth accumulation, regulatory developments, network effects or network adoption. Because those are separate things, they can intersect with each other, but they're separate, that the correlations will remain low. So I think over time, because those drivers are different, my perspective is that correlations will be divergent, and today they're close to zero. But it's I should also say this is a very limited data set, right? Bitcoin has been around for less than 10 years, and oftentimes when we look at data around financial products, we try to look for a very long period of time. Yeah. So there's two different mindsets exist, and I think they both have merit. I think that we will have to see. Crypto has largely only existed in a bull market in U.S. equities, and we don't yet know what it'll look like through a recessionary climate. So far this year, there have been a few periods where equities markets drew down, even just recently, and I believe that crypto continued to behave in an unrelated way. So I think there's merit to both sides. Over the longer run, our expectation, our research team's expectation would be that there are different things driving the value here, and sort of in the same way that you might expect gold or a commodity to behave differently, with some intersection around the larger economy, that crypto will move towards behaving a little bit like a commodity.
The other thing that I think is an interesting thing to think about, because we still are in such infancy in the space that we kind of lump everything together as cryptocurrency, right? But the reality is that if you look around, what you really see, or what I'm seeing, at least when I hear people talk, is the Bitcoin, for the most part, seems to have gotten enough legitimization by some of the bigger players, as a digital gold type of play, right? It's like a use case that's actually people are really coming around to maybe believing that that's the case. But I think that, to me at least, is very different than everything else. So right now, to me, it's like there's Bitcoin and then there's everything else. Do you think that that's the case, or do you see it differently?
It's a great question. I think that people definitely hold Bitcoin apart from the rest of the market in many cases, and um, it's the oldest by far. It represents something around 50% of the market cap presently, and those two attributes are very meaningful. Um, and so yeah, so I think and accessing it is the most widespread, right? CME,
Mm-hmm.
SIBO have futures for Bitcoin. There's some products that only offer Bitcoin trading and selling, and has the most liquid markets, the best OTC venues. So I think in those ways it's obviously distinct. In terms of the narrative around digital gold or cryptocurrency, I'm not sure. There are other assets that are seeking to do what Bitcoin does. As you know, there's over $10 billion of money that have gone into ICOs and funding new public blockchains and projects. Some of which are doing completely different things, and some of which are doing overlapping things. I think I think that it remains to be seen, both um, if other blockchains can serve a piece of what Bitcoin is doing, if they can, for one reason or another, move into to serving the needs that Bitcoin serves today. And then, of course, also if what Bitcoin is doing today isn't the most important thing, if some other use of blockchains is more important, if private payments or micropayments or remittance or allocating compute or allocating file storage or creating a marketplace for genomes or creating a marketplace for virtual goods, all of those things are experiments that are taking place today.
Sure.
The way I think of the status of crypto is that, similar to how TCP/IP and the introduction of the internet led to an exploration of all the different ways that we could use that protocol and that new technology and infrastructure. People experimented with corporate wikis, corporate intranets, which are private networks, obviously, much like private blockchains today. And then people also experimented with these unfamiliar new things like Wikipedia and putting news articles online and buying things online through something like Amazon, which at the time, if you remember, people were uncomfortable putting their credit cards on Amazon. And certainly now we also have Netflix and YouTube and all these other great services that would be hard to imagine. So anyways, I think people, it was an enabling new technology, which is TCP/IP and the internet, and then people explored all the different ways that it can be put to work. I think that's happening now in crypto. Bitcoin is just demonstrated an enabling new technology, which is a blockchain with a consensus protocol. And people are exploring, can we use it in private contexts within companies? Can we use it in public context to transfer money, to transfer ownership of items, to transfer ownership of property, to transfer, et cetera. And so I think we're in the early moment of things sort of fanning out now, and people exploring all of those different opportunities.
So, and that kind of brings me to, what you guys are doing. So talk a little bit about what led to talk about Bitwise specifically, and kind of the reasoning for your specific approach.
Yeah, great. So the firm is called Bitwise Asset Management. We're based up in San Francisco. We're about 16 people. Half of us have backgrounds in software, half of us have backgrounds in traditional index fund investment management. We're the leaders in cryptocurrency index funds and indexes. For most people, it's helpful to think about what we're trying to do for clients as the way they would think about Vanguard or S&P or BlackRock. We're focused on clients, which is a little bit different than a hedge fund, who also manages money in portfolios. But we're focused on meeting with clients, providing research, and then structuring funds. To date, they've all been index funds that help them get exposure to the space. So our flagship fund, the Bitwise 10, is a little bit like an S&P 500 for crypto. It gives investors exposure to the largest 10 public blockchains and crypto assets and then holds them in a market weighted fashion and rebalances it. And so what that accomplishes for investors is it allows them, if they have a belief that something valuable will come out of the space, there might be a valuable crypto asset one day. Some of these public blockchains might be important and valuable. It allows them to hold whatever emerges as a winner without having to guess which thing that'll be. Is it Bitcoin or one of Bitcoin's competitors? Is it Ethereum or one of Ethereum's competitors? Is it something completely new we haven't heard of? The index will hold whatever emerges as most valuable. And if that's something new or something old, it doesn't matter. And if it's one thing or if it's five things, it doesn't matter. And so it simplifies getting exposure to the space. And then we have other products as well.
That index in particular covers what, about 85% of the market capitalization?
That's right. Yeah. And that's actually very similar. I think sometimes it surprises investors, but it's very similar to the S&P 500. So there are about 4,000 publicly traded companies in the US, and the S&P 500 are the 500 largest, and they make up about 80% of the market. Yeah.
You know, one of the things I think it's the way I think about that approach, which I think might be of interest to people who are, you know, kind of understanding that there's something going on, but really just, you know, they're not tech savvy. They're not really interested in learning how to use a wallet, you know, a hardware wallet and all these things. And it sounds like a big task is to say, okay, if you believe that this space, there's this new technology happening and it's real, this is a really good way to ride the entire market cap, right? I mean, this is really buying the market in the same way that the S&P 500 is.
That's right.
And so who are your typical investors?
Yeah. So I think you said it exactly right. And what I would add to that is it's not just people who aren't tech savvy. It's also, we serve and work with a lot of the most sophisticated investors. And they, this is conventionally how they get access to spaces. They work with index strategies. They work with active hedge fund managers, but they're not picking specific names themselves. They're not integrating with the liquidity providers and the trading desks themselves. And so it makes sense that that's how they would want to approach the crypto space as well. In terms of the clients we work with, our existing products are only available to accredited investors and up. And so our cross-section of clients looks similar to a cross-section of the space today. There's a few institutional funds, multifamily offices, and investment advisors. Then there's many investment advisors who are on a platform that hasn't yet approved any crypto products. And so they will just introduce their clients to us. Sometimes they'll even set up a call with us to help their client learn about the space, or they'll just send them to our website. And then there's a lot of high net worth individuals, wealthy families involved. We, again, because of the nature of private funds, only serve a subset of the wider public. We can't serve investors who are non-accredited.
Right. Certainly on Wealth Formula, we're used to that, but we'll be playing this on Consensus Network as well. Just to reiterate, the definition generally for accredited investors is $200,000 per year for 2 years as an individual, $300,000 if filing jointly, or $1 million of assets outside of your personal residence. Anything else to add to that definition?
That's right. Yeah. So it's either those income thresholds or that net worth threshold.
You can't use your San Francisco house that went up by $2 million, though.
Yeah, it has to be outside of your primary residence, and then we have a software flow that helps verify that, which is part of how we do compliance.
Right, and that's that for those of you who are used to us talking about this is Reg D 506C, and one of the things too that I think is important to point out here, Hunter, is that your minimums are actually very. I mean, listen, you've got major investors who are dumping millions of dollars on this, but your minimums are really very reasonable. Can you talk a little bit about, because it makes it a lot more accessible for country club investors
so for our
like
first
us.
Fund, and again, we'll have multiple funds in the same way that you would expect Vanguard to have multiple different ways to get exposure to things. We have some new ones coming, but our first and flagship fund that I think makes sense for a huge majority of investors is the Bitwise 10, the large cap fund. It is 2 share classes. So it has an institutional class, which is $1 million minimum, but then it also has an investor class for accredited investors who aren't institutions. And the minimum there is $25,000. An important thing to note is that it's as an index product, it has weekly liquidity. So you're not locked up in the same way that you should expect to be in a venture fund or a hedge fund. And then we have an investor portal where investors can see the holdings on a daily basis. They can see the price on a daily basis. We do an audit. We prepare taxes. And to an earlier point, as an organization, we're focused on clients. So we want to we want to serve the most investors possible. We do monthly investor letters and investor calls. We publish research. And our orientation is very much in that direction versus I think some people have a mental model of a hedge fund manager or portfolio manager who understands something about how the market works that other people don't understand, and that person's going to go generate alpha and is going to interact with the LPs as little as possible. If they could, they would have as few LPs as possible. That is the hedge fund model. That's just not what we're doing. Again, our model is more similar to something like Vanguard.
So it makes it really simple. You want exposure, you want to get in, the minimums aren't significant. And you can basically
we have a website, and some investors can fill out the paperwork in less than 5 minutes. We built an online flow that then pre-populates a document and sends you a DocuSign, and we see some people fill that out in a matter of minutes. And so we've tried to make it as simple as possible, which is obviously, as we talked about earlier, one of the big barriers to accessing the space today is the difficulty of some of the workflows.
Yeah, and I think it's something that a lot of people may want to check out. I know a lot of people are interested but are intimidated by the tech, especially in our some of the investors that we have in our investor club. So this is a great way to do that. And you can invest in this the same way you're investing in any of our other Reg D 506C type things. So it shouldn't be that difficult.
There's also a way on our website to schedule a call with someone from our investor relations team. We have resources available. My perspective on this is that the space has been made too complicated for most people.
Yep.
Many people have high yield corporate debt in their portfolios, but it would be unreasonable to expect that they would become experts in a Microsoft triple B issuance, or that they'd be reading Microsoft's 10K to understand the roadmap for that debt and for the company that issued the debt. But that's sort of the expectation in crypto today. Not only that you'll download a different set of apps and tools, but also that you're gonna become a jet propulsion engineer,
Mm-hmm.
or you're gonna become an expert. And our view is that for the vast majority of people, it makes sense to consider an allocation to crypto, but it does not make sense for them to be a jet propulsion engineer just to invest in Boeing. And so it's the responsibility of firms like us and people like you and others to figure out how can we accurately, acknowledging both the merits and the risks, convey in an understandable way what people need to understand about the space, and that's the mission that we're all on.
So I want to just kind of talk a little bit before we go about the whole ETF space, because one of the one of the reasons why this is so useful right now, what you're doing. Well, there's a couple reasons. Yeah. One is, there really is no ETF. There's no way you can right now go and just go, buy a sort of a little bag of cryptocurrencies on Fidelity. You can't do that. And what is the implications? Where are we with the regulation? I know that you guys also in Bitwise threw your hats in on an ETF as well.
Yeah. Yeah, so I can talk about this. We have a number of individuals at the firm who have incredible expertise in ETFs. So maybe I'll mention that. I can talk about where we're at and where we see that going generally. So our firm, 16 people. Our head of ETFs is an individual. His name is John Hyland. He's incredibly experienced in ETFs. He launched the first oil ETF in U.S. history. It's the largest today. It's called U.S. USO, U.S. Oil. He launched the first and largest natural gas ETF, the first and largest copper ETF, the second ever commodity index ETF. You can imagine in 2006 when they launched the oil ETF, what were some of those concerns? That OPEC was manipulating the price of oil. That custodying barrels of flammable liquid would be a challenging custody problem. Mm-hmm. And I think from his perspective, a lot of those same issues are now the issues that we're having to grapple with, and that the regulators having to grapple with for crypto, and we have conversations with them about that. We also have an individual, Matt Haugen, who's our head of research. He was the CEO of ETF.com, which is the largest data and analytics provider for ETFs. Co-authored the ETF section of Monograph for the CFA exam. Ran the largest ETF conference in the country, and so ETFs are an important part of our team's DNA. And so to get to the second part of what I was going to say, we, as you mentioned, filed the first ETF filing for the first ever commodity index fund ETF. So firms like the Winklevosses have applied for Bitcoin only ETFs since 2013. And so, it's been basically 5 years now of slogging away at that. And most recently, their application was rejected in I believe the beginning of August. The commission wrote a 90-page letter outlining some of their concerns, and so I think that there's work that needs to be done there, and that sort of leads me to the third thing I was going to say, which is our outlook. We think that a public registered product will happen. The SEC, who's the relevant regulator, is being extremely thoughtful about it. They're having lots of conversations with firms like us about it. But they're rightfully concerned to make sure that if the public is given access to a vehicle like this, that no harm will come from it. And there's no upside, for them to put something out the door that had a little bit of risk, and then it blows up and it harms individuals. It impacts people's savings and ability to retire, and so they're going to proceed very cautiously there, and I think that makes sense, and that's the role that they play for capital markets. So I think something will happen, but I wouldn't expect it to just happen suddenly, because the crypto space is writing more articles about it and paying closer attention to it. The real issues are the ones that they've outlined, which are market manipulation. Trade volume, I think, has become less of an issue. Custody is a real issue, and so those are the things to keep an eye on for that getting improved.
One last thing I'll just point out is all of those things, and I personally, I've been thinking that this, from what I'm hearing, the Chicago Board of Options Exchange Bitcoin Fund with VanEck Solid, it sounds like something that has a decent chance perhaps in 2019. But that said, that probably would come with a potential influx of money. So it's probably also an argument to get in before that. And here's
so I think so many things, everyone has to decide where they are on the risk reward spectrum. But Uber, at one point Uber was valued at $4 million, and there were a lot of reasons to believe that would never work out. And there's a lot of uncertainty, and they hadn't been rolled out in multiple cities, and so there was a ton of risk and a ton of upside, and there were investors who at $100 million didn't think that the risk reward made sense, and investors who had $10 billion didn't think that the risk reward made sense. And now they've raised money at $50 billion, and there's some people who don't think it makes sense. And so everyone is going to wind up somewhere on that curve. But I think the fact that there are still these meaningful risks, and there is still this meaningful infrastructure that's not in place, is part of what creates the opportunity for investors now, who are willing to bear that risk in exchange for the opportunity for the return.
There sure is a lot of smart money in there getting in line, folks. So check it out. Again, Hunter, what's the website?
Yeah, the firm is called Bitwise Asset Management. Bitwiseinvestments.com is the website.
Definitely check that out. Hunter, once again, thanks so much for being on the show today.
Thank you. I really, really enjoyed chatting.
I'll be right back. Want to buy Bitcoin with your IRA? Don't waste your time on expensive IRA custodians. A strategy called a QRP is as easy as writing a check. Find out how. Text 44222 and type QRP book. That's one word. And get a free book that explains everything. Again, that's 44222 QRP book. One word. It's the easiest way to make Bitcoin and other cryptocurrencies part of your retirement. All right, well, welcome back to the show, everyone. Now, if you believe in blockchain and distributed ledger technologies, now is the time to think about buying, not when you're at 20,000, right? So maybe you'll watch this, maybe it dips down a little bit more, but if you're going to get in, you want to get in when, there's blood in the street. Right now, there is a little bit of blood in the street. I actually think there will be potentially some more. So, but you may want to layer it in, and this is a really good option for those of you who are accredited and consider putting a little bit of money in. It can even be through, your self-directed IRA money, or as I generally prefer, through QRPs. And you hear the commercial that we always have on this about QRPs, so check that out, how you can use that. Anyway, on to today's questions. The first one I will play here.
Hi, Buck. This is Clay. First, I want to say thanks. I enjoy both your Wealth Formula and your Consensus Network podcasts. Appreciate what you're doing to kind of get information out there. I received an invitation to join Initiative Q, which is apparently some type of payment system that's being started by former PayPal guys. And I wanted to understand how it fits within the whole crypto universe. So I'd like to hear your thoughts on it. Thanks.
Well, Clay, I can't say that I initially even knew what Initiative Q was, but I actually looked up the website. What it's basically doing is it's creating a network effect, right? So it's interesting. When PayPal first started, people thought Elon Musk and those guys were nuts, but what they were doing is they were literally paying people. I think they were paying people like $10 to actually join PayPal. The idea was that if they could create this adoption with a ton of accounts, and people would just start using it, and that would create value. Now, of course, so I think there's some element of that, and in the case of PayPal, it did work. Here's my concern about this. And first of all, I mean, hey, if they're just asking for an email and not asking you to give anything and not have any private, anybody who asks you for a private key or anything beyond just an email address, stay away. Even an email address, that's totally up to you. I generally prefer not to give mine out. Although, it's, at least reaching me on info@consensusnetwork.io is pretty easy. But listen, I think that there are so many concerns around these kinds of businesses right now. And if you literally watch the video on the website at this Initiative Q, the idea is that you'll be given some kind of currency if you join, and that currency will inherently go up in value because there'll be more users. And so this is apropos of something that the SEC has just clamped down on, has just made some big announcements on about ICOs and a lot of this sort of funky stuff going on in the securities world that they're going to clamp down on. There's something called the Howey test, which is effectively, there's a few different elements to this to determine whether or not something is a security. But one of them is that you basically get something with the intent of it going up in value. Now, this is an interesting thing because all they're asking you for is an email, but there is some value to that email. So what they're saying in theory is you give me your email. Because you gave us an email, we'll create an account for you and give you a certain amount of something that therefore would go up in value. I would argue that kind of, that is, again, a type of potential security. And so I think it's, these are exactly the kinds of things that I think are going to be the target of the SEC. Now, you as a consumer, as long as you're not putting any money in, as long as you're not, giving somebody some kind of a private key or anything like that, there may not be a lot of danger to you. Personally, to me, it just is starting to smell of a lot of the things that the cryptocurrency world is trying to get away from so that we can take this thing mainstream. But listen, I don't know a lot about it. And if there are some differing thoughts on that, I would appreciate anybody else's comments. Shoot me an email at info@consensusnetwork.io or shoot me a voicemail or whatever. But again, I just wouldn't take it very seriously. I just think it's just one more thing right now that it's just noise in the background, and especially with all of the crazy stuff that's going on with the SEC right now. I don't even know if it's really even worth giving up your email for, frankly. So, but thanks for the question. Next question is from Jake. Simple question here. How can I tell if an airdrop is real or fake? I always see things as saying that they're going to give out free tokens, but it's not clear if it's real or not. And that's actually a really good question. I mean, I have to admit, like sometimes I've never been fooled, but I'll look at something and go, oh, that's interesting. Because why is it in the first place that, these tokens do airdrops? Well, they do airdrops because, again, it goes back to part of what Clay's question was about. The only thing that really gives something value is if a lot of people are using it. So if a lot of people know about it, a lot of people are using it, then it creates value. And so a lot of the times, these airdrops are good ways to create that kind of buzz and get them in the hands of potential users, etc. So I've been lucky. I've gotten a few of these airdrops. And it's funny because when I was first got into crypto, some of the stuff that I ended up really liking, some of the projects that I like. I mean, for example, one was Tron. I think I got a Tron airdrop in my Binance account, and I didn't know what it was, whatever. But I looked the project up and who was involved, and next thing you know, I actually I actually put in a little bit more money and bought a little bit more Tron. So that's kind of how the way the airdrops work in the first place. Now, the reality is that the good thing about cryptocurrency and the way this whole thing works is that it's a very simple thing. If somebody's asking you for information outside of your public key, don't give it to them, right? Because you can't do anything with somebody's public key. That's the beauty of it. Somebody can give you stuff, but they cannot take anything from you. If they're asking you for more than a public key, if they're asking you for an email address, don't give them your email address either. They don't need that. If all they're doing is an airdrop, then all they need is a public key. So especially if they're asking for private keys, run the other way because you never want to give anybody your private keys. But that's one simple way to be safe, all right? Give away a public key, no big deal. Your public keys, no one can do anything. You look on YouTube right now, you'll have people publishing their public keys. They say donate to this address if you like what I'm doing, etc. And so you can't do anything with it. The next thing I would say is what I like to do is I like to follow specific projects on Telegram. And actually, we have our own Telegram channel for Consensus Network, although no one has actually used it, and that's probably because most of the listeners here are not seasoned, cryptocurrency people. They're relatively new. Maybe you're a sophisticated investor like Clay coming off a wealth formula, whatever. But Telegram is this app, and it's actually a distributed ledger app. And Telegram has all these channels, and you can look up channels for specific projects. And if you get the official channel for a given project, that's probably the best place for you to learn about airdrops for a given project. And usually, though, the airdrops, for the most part, they'll come to people who are in the Telegram group, whatever. A lot of airdrops just happen because you happen to open you own a coin, and suddenly you own a token, and suddenly you get a token and you don't even know it. I mean, in my Ether wallet, where I have a number of my ERC20 tokens, I have all sorts of tokens, and I have no idea what they are, and they're all just basically from airdrops or splits, forks or whatever. So hopefully that answers your question. It's sort of convoluted, but bottom line is, don't give away your email. Especially don't give away your private key to anything. Public key, you can't do a lot of harm giving away your public key. So anyway, that's it for this week. This was a tough one, folks. So hang in there. And again, remember the whole saying about Warren Buffett, what Warren Buffett says about investing, right? It's basically, be fearful when people are greedy, and be greedy when people are fearful. And right now, people are fearful. There's no question about it. And I think I would also suggest maybe listening to Tyler Jenks a little bit more. I mean, again, I'm not a trader, but this guy sure did call it, right? And so I've been listening to his Hyperwave channel. Him and Tone Vase, who also was on our show in the past, are often on there together. And, one thing that Tyler said that was, I think was actually pretty profound for me. And you guys probably all already thought of this, but, I was like, well, what if you miss out on an upward movement? And he said, well, we won't miss out, because we'll see this thing going up. You might not get on till it's at 7,500 or 8,000 or whatever, but we're planning on this thing going to 50,000 or 500,000. And the amount of money you can lose, on the other hand, is significant, right? So, if you have, 50% of your net worth in cryptos, you could lose, a quarter of all your money, and that's not a good place to be. So it is a, again, I'm not a trader, but based on the fact that Tyler really called it, I think I'm watching very carefully on his Facebook or on his YouTube page, his Hyperwave page. I'm watching very carefully what he has to say, and I may actually go in and buy some stuff when I think we've really bottomed out. So anyway, that's it for me this week on Consensus Network. By the way, as a reminder, if you are looking, you want to pull the trigger when there's blood in the street, go to consensusnetwork.io. There's some tutorials on there, how to buy Bitcoin, etc. If you open a Coinbase account, you'll get $10, and so will I. Everybody will be happy. $10 of Bitcoin. And anyway, check it out. Even if you don't end up doing it, it's a good way to learn and be prepared if you decide to get involved. That's it for me this week. This is Buck Joffrey with Consensus Network, signing off.